All right. Good evening, good afternoon, good morning, everybody. We're so excited for our workshop today. This is our last Bridge event of the year, and it's been an incredible year, very busy year as well with Bridge, as all the members here seen it. And we're very, very excited to finally finish it, but also in a beautiful way with this incredible workshop hosted with our partner Vessel. So before we start, please, GPs, make sure if you can to put your cameras on. Would love to make this as interactive as possible. And also, if you have any questions throughout this session, you can write it either in the chat or you can, unmute yourself, raise your hand, and we'll take the question. The goal here also is not just for our partners to speak, but also to answer all the questions that you have. All right, so I would like to present our speakers today. We have with us Thomas Terra, who is the co-founder and CEO of Vessel, which is an all-in platform that has helped to help you fund manager raise and manage capital more effectively. But also we have two incredible speakers with us here today. Ron Mayer, who is the founder of the Sigma Family Office, and we have Carrie, the associate partner at Mavericks Private Equity. Thank you so much, the three of you, for making the time today to talk to our incredible founders, GPs that you have here today. As I mentioned before the call, they're all incredible people to be around, and we're very excited to make this happen. Thomas, I'm going to throw the ball to you now, and enjoy.
Thank you. It's great to meet you all. When Amin first mentioned the opportunity to do something together, I was very excited. And for the main reason is because we share the same ethos. What we do at Vessel is very close to Bridge Funding Global's mission, which is we want to bring the community together to redefine GP-LP partnerships. So what this means is share best practices in a practical, applicable way. That's what we're going to do today, hopefully. Break down barriers between GPs and LPs. It's a very opaque market. It's very hard. Every LP can be its own beast, so to speak. And so how do we make LPs and GPs work more closely together? And I'm sure Ron and Carrie will share great ideas here as well. And three, rethink the LP experience. The market has evolved dramatically. Today, any LP in the world has access to a good firm, a good fund. So the LP experience now matters much more than it was the case when I started in the industry 15 years ago. So without further ado, obviously very honored to be here and to have Ron and Carrie joining us. Three themes we'll talk about today. So the three kind of key takeaways that we want you guys to have today, and it's meant to be an interactive session. One, how family offices build private market allocations. So it's really putting ourselves in the shoes of the family offices and understand a bit better how they see this world of private markets. Two, what it takes to build trust with family offices, and what does the GP family office relationship look like. And three, I really want to pull from our speakers' experience and extract as much as we can on shared experiences and best practices when it comes to partnering with family offices. At Vessel, we work with a lot of managers, whether they are kind of proven, established, or whether they're kind of starting their own business. We work with GPs across like 8 countries, 3 continents. And so we're always very excited to share what we see working on one end, sometimes in one country or with some certain type of GP, and share these best practices with the rest of GPs. And so whether your strategy is, whether you're in seed investing, venture, deal by deal, secondaries, we've seen a version of what works and the version of what doesn't, at least. And we'll make sure also to share these insights. So without further ado, let's dive into part one. So the way it's going to work today is we're going to have 3 sections. We have an hour and a half. So we have plenty of time. So we're going to have a section that is more like first part is going to be more about the lay of the land. And then the more we progress, the more we'll dive into discussions. But before we dive in, I would love to have maybe an intro from you, Carrie and Ron, on kind of your background, your experiences, and yeah, for the audience, and start with this.
Sounds good. I'm happy to kick it off. Thanks so much for having me. I'm really excited to just be here and meet everyone. I'm Carrie Golick. I'm an associate partner of capital at Mavericks Private Equity. Mavericks is a growth equity fund focused on minority private equity based out of Toronto. I say run our US office, which is my apartment, but I am the kind of sole US presence here as we think about expanding into the US and finding LPs there. But I oversee everything from investor relations to fundraising. We are currently wrapping up investing out of Fund One and fundraising Fund Two right now. So in a similar position to many of you on the call as well. And then prior to Mavericks, I was at Abbott Capital, which is a fund of funds and secondaries manager based out of New York. But yeah, just really excited to be here and collaborate with you all and share some insights.
I'm Ron Mayers. I'm the founder of Sigma 2 Family Office, which is neither multiple nor single. We describe ourselves, we like to use the word singular, but what that really means is that we're a private family office of half a dozen families. Admission is by acclamation. So we are not particularly interested in business development. If somebody has a friend and they want to work with us and the other families are okay with that, we'll take them on. And the reason that we do that is because the wealth creators that we work with are our investment committee. We take a very collaborative approach. It is a non-discretionary approach. So essentially, if you came to us, if Carrie came and wanted us to have a look at this Mavericks fund that we're developing, I would go out, she would be one, or Mavericks would be one of half a dozen that I might analyze in a particular strategy. We'll then sift through that, filter out, pick the best two or sometimes three we think in that strategy, and put it in front of the actual families. They then have the opportunity to analyze the investment guided by financial professionals here at Sigma 2. And from there can decide that they want to allocate, don't want to allocate, they can allocate, and then their allocation, of course, is based on liquidity and conviction. So it's a very unique structure, but that's true of all family offices, right? If you haven't heard the phrase already, it is often said that if you've seen one family office, you've seen one family office. We all operate differently. We think that we're unique, but I think some of the messages that we can bring across to you today are universal, and I hope that they're helpful to you. Personally, my background, I practiced law in New York City for 7 years, met a girl from Montreal, moved here, went to work in investment banking, was engaged in the care and feeding of hedge funds, primarily in the value space and merger arbitrage space. This was in the 80s and 90s. Went and had a hedge fund of my own, Genoa Capital, which was an event-driven strategy that lasted for 5 years. Returned our capital simply because our performance was average. And I was enjoying being on the sell side and working with the hedge funds directly. Built that business, retired, and was trying to figure out how to effectively invest my own capital, and realized that if I could join with a bunch of people that were smart and had access, I would be a lot better than trying to do this on my own, simply because of the size of the checks that were required to access some of the better strategies out there. And that's how I gathered my families together, and we started Sigma 2.
So I think, Ron, a reason why I was very excited also to have you today is we can say you've seen it all. I think you've seen it, like also more particularly, I think the rise of private markets in family offices portfolio started with alts, you mentioned hedge funds, and now, obviously private equity, and, I'll let you talk about it, but you have a very unique model in terms of how you look at investments. And Carrie, I think also what I want to kind of dig deeper on today is you know what it is to sell multiple products to different family offices in private markets, And I think also for the audience, we'll touch on your experience positioning, in some cases, maybe more mature products, like it was the case at Abbott, or with Mavericks, which is a product that LPs know, but it's also a new firm, which has obviously for LPs can be very attractive, but it's also not always easy when you build new relationships. So we'll dive into that as we go into maybe our first part here. I'm stating the obvious here, so I just want to run through this very quickly. But you have in family offices, their kind of exposure to private markets have grown significantly. Today, we have roughly 8,000 single family offices worldwide. The average size of a family office is 1.1 billion. They are, in terms of assets, 3 trillions owned by managed by family offices, and that's growing, almost doubling by 2030. So as a GP, definitely like the TLDR, which is obvious, but you need to build a motion, a strategy to go and attract family offices, because that remains one of the, I would say, fastest growing segment of the market when it comes to being in VC or in PE, but also it's very different than private wealth or institutions. So there are really a lot of opportunities today if obviously you can play this segment well. If we look at and maybe we can start also the kind of the panel with you, Ron, here. But when you look at and maybe you'll disagree, by the way, with this slide, but typically family offices allocate capital across many asset classes. You have public equity, private equity, including PE and VC, real estate, private debt, and I'm sure I'm forgetting some categories here, but. Ron, based on your experience, and based on what you do today at Sigma 2, what's your, and obviously don't want to say anything confidential, but how do you think about global allocation as a family office, and how does that differ from what you see on this slide?
Doesn't differ a whole lot from what we see on this file. We are increasingly moving away from public equity to the extent possible, and towards private, and within private towards direct. Simply because of there's so much that's being generated within the family office community. But on the direction the public markets have taken, I guess, since the great financial crisis, where I would have to say the Fed has infantilized the investment community, has made us very, very nervous. The notion of meme stocks, the notion of gotta own it, don't care what the price is. And we just kept finding the traditional measures of value that we applied to trying to allocate in public markets wasn't working. It doesn't work anymore. And I can't tell you whether it will ever work again. I have no idea what's going on in public markets, but it is a circus. We have a certain amount of exposure. Our exposure on both in equities and in fixed income, traditional fixed income, are through tax advantage vehicles. I think everybody in the United States is familiar with the concept. That's less available here in Canada, but we are constantly, so on the private equity side, we're in a tax harvesting fund that's pegged to whatever index our client wants. We've found something, Neuberger Berman provides it for us in this case. In fixed income, traditional public fixed income, we're also in a tax efficient program. It's not, you can't harvest losses in fixed income, but we invest through a vehicle that has some tax losses in it. And I would have to say that, yeah, it's about 30%. No, we are probably 20% private equity, and probably a little lower, and about 10% right now in fixed income. That's a different category than private credit.
Okay, and so if we think about, so this could be considered a good baseline for family office allocation, like a good rule of thumb. And just curious about and maybe this is a good question for you, Carrie, on this, and would like to hear you run on this as well after on the me when I was in the industry at Terralis Capital, we were positioning our firm with family offices, and at the time it was very hard, especially in Canada. With the cycles, fund of funds, sometimes our products that are 15-year average when it comes to sometimes longer. Lack of liquidity is even more kind of prevalent in fund of funds. just curious, from your perspective, Carrie, how have you seen, like, from your perspective at Abbott, maybe at first, the interest from family offices growing for the asset class?
Yeah, it's a great question. In terms of interest for the asset, in terms of private equity or specific fund structure, sorry.
Yes, at Abbott, I don't exactly remember all the products you guys had, but from it could be a fund structure, it could be any specific product you guys were offering at the time. I think you had like a core like flagship fund of funds, more VC oriented, but appetite in general, I would say.
Yeah, so at Abbott, in terms of family office interests over the last few years, we were seeing the most in the secondary space. And then with larger family offices being able to do more bespoke mandates, actually. So some interest across the fund of funds space, given their ability to kind of customize their exposure and kind of complement their perhaps gaps in their portfolios, or just being able to kind of complement with what they maybe couldn't get access to. So at Abbott, we invested from venture from venture all the way through kind of middle market buyouts across North America and European private equity. And folks could pick if they wanted exposure to venture, lower middle markets. And you could pick some combination of those. And so that was a great option for family offices that maybe had a lot of expertise and access across, let's say, venture capital, for example, but they just haven't been able to break into the lower middle market. And so they would come to us and want kind of a dedicated fund sleeve. So they could invest in a traditional fund structure that way. But with larger family offices, we were just seeing a lot more interest, kind of in a similar approach, but just something more bespoke in like a segregated account or a fund of one, excuse me, where they could have a little bit more say and discretion throughout the process. And also over time, kind of build those relationships where maybe they wanted a partner like Abbott to start out, build those relationships with the GPs, and then over time, kind of take that relationship over, after maybe a couple fund cycles. So I would say those were the two main ways in the last few years that we were seeing the most interest from family office as secondaries, just to kind of scale up exposure, and then more bespoke mandates versus a more kind of off-the-shelf solution with kind of a set asset allocation.
Yeah. So for you at Habit, it was really the flexibility that enabled you to build relationships and come with more bespoke exposure, which is very interesting, which is exactly the opposite of what we did at Terralis, where we had one product venture, which was harder. Great. Ron, curious
And it was
about.
great, yeah. And it just in general was about kind of meeting family offices or LPs in general, kind of where they were and understanding what their needs were, and then being able to adapt accordingly. It definitely made kind of the overall structuring and reporting a little bit complicated because you would have kind of one overarching fund, but then you could have people that were 50-50 venture, small buyouts. They just took kind of the house mix. It was kind of and anything in between. So a bit of a headache on our end, but I think it was something that resonated with LPs, just being able to kind of cater it to their needs.
And from your perspective, Ron, what were kind of the way of working with a GP or the structures that kind of at first, when you started building allocations that kind of enticed you or made the case for you and your families to go and allocate more to private markets?
I mean, I don't think it is any secret that alignment of interests is a critical factor. So what are we looking for? We're looking for skin in the game, right? We want to make sure you're eating your own cooking. We want to make sure that you're not receiving any type of preferential treatment, relative to the typical GP LP structure. We are fee sensitive. We are and recently have become very, very exit focused. We've had the unfortunate experience of being gated twice. Shame on us. And in those exercises, I went through the LP agreements and basically realized we had no rights. we were literally at the mercy of the general partner, that I could not, if I had every LP lined up saying, we want to take this fund over, or we want them to dispose of their assets, or we want them to wind up, there was literally nothing that we could do. And so that's become a real sore spot for us. The quick way to do it is to avoid evergreen, right? Work only with closed-end funds. And so that's kind of a preference right now. So you may want to keep that in mind when you're structuring. But the other way to do it is to make sure that you know how you're going to react when you fail to meet expectations, when the markets go against you. You get gated. It's not the manager's fault. No one could foresee or reasonably foresee the pop in interest rates that we experienced a couple of years ago that forced so many credit funds onto the sidelines. But the question is, what's your strategy for that? What are you going to do? I accept that you have an obligation to the partnership as a whole, not to engage in forced sales. There are people that want to retain, so you have to protect your existing capital. But there has to be a way for LPs to communicate better with general partners. And the best thing that you can do when you're falling behind your expectations, the market is moving against you. Nobody holds that against the manager that is transparent and timely and truthful. If you had a particularly bad month, that's a really good time to reach out to your LPs. And if they're big investors, they should get their own phone call. And if not, they can jump on a phone call with everybody else. But bring everybody in on what you're doing.
Yeah, so alignment and relationship for you were key in kind of expanding private markets allocation. And what you said, I think, is a good segue to our kind of next topic, which is, when you I think for a lot of GPs, this is a bit blurry, like funds, co-investments. We see family offices very passive, very happy with funds. We see some family offices with their own direct investment team, trying to participate in deals, sometimes co-leading deals. So there's no one model, but from your perspective, working with your families, like how would you allocate kind of on across these three categories? What do you guys do most, and how do you think about these categories?
Is this for me?
Yes, this is for you, Ron.
Okay, so why do we like private markets? We feel we have more control over what's going on. Why do we like direct? Because we like to bring our expertise to bear. If you think about just the way our family office is modeled, for purposes of this conversation, each one of the 6 families made their money in a different way. Each one has a different form of expertise. So we like to collaborate to bring that expertise to bear. But within the family office community, the larger family office community, we do the same thing with other family offices in Montreal, other family offices in Toronto, and through a platform that we have now, 80 family offices in the United States. So we are constantly trying to be able to lever our expertise. That said, there are compelling and timely strategies for which we can add no value, where we have nothing, we have no background, and that's what we're looking for in terms of funds. We're looking for niche players. We're looking for people who do things that we can't do really, really well. So in terms of what we have in terms of passive strategy, CLOs, synthetic risk transfer, we're involved in a fund that that invests in small cap and medium cap financial institutions, literally globally. 50% of their assets are here in North America, 25% in Europe, and 25% in Asia. We love that. Our approach is incredibly disciplined, but our portfolio is very, very eclectic. So what we're looking for is the secret sauce. We're looking for how you differentiate yourself from the other people that are out there. And of course, we're looking for performance. And the good thing about a family office, and the thing to remember, is we are not institutions. So if you've geared your platform to institutional investors, it is not going to resonate with family offices. But if you're small and your target is ultimately to get to the institution, we can be your best friends because we make our decisions fast. We don't require a 5-year track record. We don't care if we're 5 to 10% of your assets. If we like what you're doing, we'll back you and we will get you to that next level. But the quid pro quo for that is, again, transparency.
Love it.
Yeah, that's definitely something that I was gonna say that's definitely
Go
something
ahead.
that I've just noticed in my conversations with LPs over the years. I find and I've worked prior to Abbott, I was at a private credit fund, and it definitely at that point, back in like 21, 22, early days of private credit, kind of prior to this boom, and it was asset-based lending, and it felt very niche, and we'd speak with these large institutions, and they were trying to figure out like where do we fit, like what bucket do they go into their very strict portfolio or asset allocation, and it would be frustrating at times. But then with family offices, I feel like the more niche, the better in a way. And when it's something that's like hard to understand, if it's structurally kind of complex, I feel like that's when their ears kind of perk up, and that's kind of what gets them the most excited if they can't necessarily go um, do that themselves. And also to Ron's point, yeah, I think one of the benefits just in terms of having family offices as partners is their ability to be more nimble and potentially kind of deviate from their asset allocation and do things that maybe um, they maybe wasn't on their radar 6 or 12 months prior without super strict guidelines necessarily. So yeah, that just kind of anecdotally kind of definitely resonates in terms of just what I've seen over the years with LPs.
We
And
have, sorry,
yeah,
go
go
ahead.
ahead. I mean, if you wanna, I was going through the questions, but maybe go ahead and tackle them.
Actually, yeah, those I was going to tackle the questions, and I had a question also on
Yeah.
my own that I will bring up
Okay.
after the questions.
Okay, no
All
problem.
right, let's start with Mara. What other LP friendly terms in the LP do you immediately look for?
I'm sorry, I mean, just repeat that for me.
Yeah, what other LP friendly terms in the LPA do you immediately look for?
Like I said, we're trying to figure out how, if everything goes south, we can get our funds out. Okay, we're not interested, in hanging around and waiting for the markets to get better. So liquidity is a concern within the context, and I understand. I ran a hedge fund. I know that you just can't have capital walking out the door. You've got to be able to manage that capital flow in and out. But there's got to be a way where if you're not meeting expectations, you're not forcing your LPs to sit around while you try and make it work.
All right, thank you. Well, then you have a question from Alex, who said, just a few weeks ago, I was informed of potential tax issues for Canadian LPs investing in US venture fund. Is this only a recent development and what are the workarounds?
I mean, it's not you, it's me. I'm slightly hearing impaired. I just need you to repeat the question.
Yeah, of course. So a few weeks ago, Alex was informed of a potential tax issue with Canadian LPs investing in US venture funds. Is this only a recent development, and what are the workarounds?
Yeah, so Alex, there are a couple of, sometimes there are and sometimes there aren't. I'm not necessarily sure of the specific tax requirement that you're inquiring about. But if you were trying to do private placements in Canada, it may be the case that you were required to work through an exempt market dealer.
No, this is about an LP. I think it was a double taxation situation.
Okay, so the way that we deal with that is we set up a blocker in the United States. It's not expensive to do. I know that as an LP, you can't give them as a GP, you can't give them tax advice, but you can always kind of suggest a structure. So when we run up against that, we've got an in-place U.S. blocker that we run everything through that. So
Got it.
if you're structured as a C corp, it's not a problem. If your structure's an LLC, it can be.
Yep. Okay. So it's a blocker. Got it. C Corp blocker. Okay.
Yep.
Thank you.
All right, and I had a question to everything that you said, Ron, about the differentiation and the transparency is something that we also value a lot here at Bridge, and it's one of the key factors of GPs joining as members as well. But would love to hear from you factually on the transparency part. How can they be more transparent, and what are you kind of looking for from GPs to do? And on the differentiation as well, what is it that you like the key metrics and things that you're going to be looking for, and what's going to make a difference between one fund and the other, if they're both very
So I'm happy
similar?
to answer that, but Carrie's got a lot of experience, I think, in investor relations, so she may have some thoughts there.
Yes, for
If I
sure.
put you on the spot, let me know.
No, all good. So yeah, I mean, I agree. I think just transparency is paramount with investors, and I think especially to Ron's point earlier, I think look, it's always easy to communicate or over communicate when things are going well. I think uh, it's obviously more difficult, but I think that kind of silence is a lot louder when things might not be going as well, and then your LPs are not hearing from you. So I think if something, whether it's performance, a key departure, maybe you have a secondary going out of your, an LP's decided to do a secondary for like whatever the situation is, I think it's just best to get in front of that early and be able to control that narrative. And I think in ways over communicate. Again, I think that's also just kind of my own approach is I don't want to feel like I withheld information from anyone or people hear stuff through the grapevine. So I think just being transparent as much as it might raise some initial questions, it might be uncomfortable. I think it just ends up paying dividends in the long run, especially when you're earlier on in your fund life cycle. I think just being able to communicate these things and also just especially if you talk about transparency early on in the process that you want to be partner oriented, like this is something that you're showing like you're doing what you said you're going to do. So it's important to not only execute on like your investment strategy, but also if you say that you want to be a partner, like this is one of those opportunities to be able to step up and actually do it. So yeah, I would just say I think kind of constant communication, whether it's just small portfolio updates, team updates, some type of newsletter. I think having those strips, but then also getting in front of LPs when things are not maybe as good as you were hoping, I think is very important.
So that I mean, Carrie pretty much covered it all, but it's that phone. At the end of the day, when you're dealing with a family office, you typically dealing with a gatekeeper, right? Whether it's an analyst or a CFO, you're typically not talking to the head of the family. So that gatekeeper is typically a financial professional who can really understand what you are going through and what may be driving what's happening. So what I need, okay, is a narrative. I need to be able to explain to my investors why you're underperforming, why you're overperforming, why you're not calling capital, why you're calling capital so fast. We love that macro picture of whatever you're doing. We know we are happy to hear about your problems. Why? Maybe we have some value we could add, but so anecdotally, okay, we doubled down on a guy who we felt had gotten beaten up for no reason, had a clear strategy for exiting. He was fully invested. He couldn't take advantage of the downturn, and we wrote him a check. Because he came to us and said, "Can you help?" But you got to know your customer, right? At the end of the day, you need to know who you're talking to and how they're going to respond to that. So it's, again, these personal relationships. And I certainly don't want you to encourage anybody to call the gatekeepers and take them out for a lunch or have coffee with them or have a chat with them every week. They are too busy. But when you know that your fund is going to be on their agenda, get ahead of them. Okay? Make their job easier. Make them a bridge between you and the family so that everybody's on the same page. It is no sin to underperform if you're sticking to your strategy and the markets are going against you. That's the risk we take. That's the execution risk. That we can forgive. Strategic drift, not so much. Over allocation, not so much.
Thank you.
One thing I would add to that is, seeing it with our GPs is as you grow your number of LPs, it's hard to maintain what's hard is having in your brain okay, always like notes or mental notes of, oh, I need to call these LPs or how do it. So I think it's a mix for you, what we see the GPs that do it the best way do. They have a baseline that is very strong, as Kerry highlighted. So you need to have a key infrastructure of reporting, updates, monthly updates, maybe quarterly updates, worst case scenario. But then you need to have an infrastructure where they feel they're in the loop. That's very important. And then you need to have a way where you can, as Ron said, text them, call them when there's something coming up. And then it's more okay, you review your list of LPs, you're going to call all of them because they're going to talk to each other as well. So if someone also is not in the loop, it might be harder. But if you want to, that's where you get the most leverage of your time. And obviously, calls are for very important things. And then ideally you have also a regular, either a quarterly LPAC. In the US, I tend to see a lot of funds that try to push the LPAC on a semi-annual basis or annual basis, which I think is an error. So I would have quarterly LPACs or quarterly investor calls. So make sure, I think if you have a strong baseline, your LPs trust you more. And then it's easier to do every time you hop on a call with them, they feel it's in the loop, it's additive, it's a 5, 10, 15 minutes. It's not like a big catch up, easier to maintain trust across the board.
And remember that family offices talk to other family offices, right? We can be a source of new capital.
Yeah, and
absolutely.
Yeah, and then just on your reporting point, so just us personally, we do quarterly LPACs, and that seems to resonate. Have not gotten any feedback that it's overkill or anything. And so we do the LPAC quarterly meetings, meeting decks, and then quarterly reporting for investors. And then we do a semi-annual webinar. We can always up that if people feel like it's not frequent enough, but so far the feedback has been quite positive between doing the semi-annual and then we do an annual, not an AGM. We do more of a summit or conference of sorts for the day that includes all of our LPs are invited, plus founders, just generally other industry contacts. So that, and then we feature our portcos there. So it's an opportunity for us to see all of our LPs in person, and that kind of breaks up also the semi-annual cadence. So, but yeah, it isn't true. I do feel like a lot of people, especially on the LPAC, are going to more of an annual route to kind of align with AGMs.
Absolutely. And so I think it's a good segue for us to discuss a bit the next section around how you build these relationships. I think, there's a lot of experience we can unpack also from Ron and Kerry here. I'll skip the first two slides and you'll have the deck. We'll share the deck, obviously. But more on I think on decision-making process, and, maybe starting with you, Kerry, if you had to, based on your experience, how do you see, how have you lived these processes, as having some of the most prestigious institutions as LPs, and working with family offices, how do you approach them? What are the key differences?
Yeah, so I mean, I would say in terms of just the diligence process on the family office side and private wealth in general, generally a shorter process versus the large institutions, especially with being an emerging manager, as Ron mentioned before. Generally, I feel like there's going to be a lot of generalizations because again, no two family offices are the same, but I feel like generally family offices will be a little more forgiving or flexible in terms of track record for, whether it's fund one, but they also want to dive into probably your prior firm's track record if you're raising fund one right now. And then also being able to do a lot of reference calls. I think the references, again, because I think family offices tend to kind of group together and rely on each other in terms of network effect. I think the references become arguably even more important, I would say, in that space to kind of combine some of the quantitative and qualitative aspects for due diligence. So I would say that that's definitely more important, but generally the due diligence process is going to be I'd say a little bit shorter. And then again, I think just like references and also seeing like, okay, who else is invested in you? I think having that blend of having the backing of some institutions, but also seeing that kind of like-minded or similar types of LPs or investors is also important.
I mean, I think this is a very kind of effective and truthful slide. I mean, this is the way it works. And we act on instinct and alignment. We will make a decision if we like it, like something, the way that we typically work. And again, this is our structure, and I don't want to bring the particular to the universal, but we'll get off the call with Mavericks. The 5-6 families will be sitting around the table, and we'll decide. We've seen everything, or we won't. We'll say, okay, let's go into the data room. Let's take a deeper dive. But you're going to get an answer a lot faster. You're going to get a lot more compassion than you're going to get from an institution. And I think that's what makes us, and a lot more patience. The longer we can hold an investment, the happier we are. And as long as you keep performing in line with the way that you represented that you would, we will stay with you for a very, very long time. But again, alignment of interest, and it's hard to do because family office, the interests of family offices say, let's use a direct private equity transaction, may be very different than a pension fund or a college endowment that needs that liquidity now, wants to move on from this investment versus a family office who sees a growth curve that's just going like this and wants to ride it out. And that's where I think Mavericks comes in very effectively because of the secondary aspect, right? They can create that liquidity for the institution and provide it to and then look to the family or another institution to help that. So it's almost two different pitches, but they have to be the pitch is pretty much. I mean, you can't change the facts. It's based on the same facts. But why would an institution want to invest in my fund? Why would a family want to invest in my fund? And it's hard to build that. But it can be done. And as I said, if you're a smaller fund, if you're fund one, I think the best way to put it is we've already picked the horse. We know the asset class we want to allocate to, and we're probably drilled down on the strategy too. So we're really looking to bet on the jockey. Who are you? What have you done? This track record that you bring from Blackstone, was it yours or your team's? Okay. What do you bring to this? And that to us is a critical factor. Whether institutions make the decisions based on that criteria, I cannot say, but I hear it time and time again. Bet on the jockey, not on the horse. Okay, and that goes to performance. Okay, we picked the wrong horse, we can deal with that. We picked the wrong jockey, it's not so good.
Ron, can I just ask, I'm curious, let's say you're evaluating a manager that's raising fund two. How would you evaluate their maybe fund one track record versus like prior firm track record? Do you kind of give them maybe equal weighting? Are you a little more maybe forgiving if fund one's maybe not off to the start, but you still see a lot of conviction in their historic ability?
Yeah, I think it varies. I don't think there are any hard and fast rules. I mean, one of the things typically fund two is going to be a larger raise than fund one, right? So you have that bias. Smaller funds always do better. They're more live. Their investments are smaller. I mean, I know this from running my hedge fund. We behave very differently at $10 million than we did at $100 million. So the second raise is going to be bigger. So are you scalable? Is what worked in fund one going to work in fund two? So we're going to look at the best. We're going to say, tell me what worked for you in fund one. Show me an investment that you really loved. Okay. And the next question will be asked, okay, so could we do that at 3 or 4 times that size as you grow? If you're making money off of small deals that you can't repeat on a scalable basis because you can, that's great. But ultimately, we need to see some kind of scalability with your best ideas.
But also, I've seen this definitely at Abbott. This was something that, again, being the fund-to-fund space and being allocators as well as raising our own funds, we would look time and time again at managers that were scaling too quickly, that maybe they raised 100 million fund one, and then they're back 3 years later and they're raising 500 million. And so I definitely think also having like that fund size creep, where then let's say you start out in the lower middle market and then all of a sudden 5, 7 years down the line, like, two fund cycles later, you don't really look like what you originally started out as. So I think also just being disciplined in your deployment, and not trying to just raise bigger funds and kind of turning into that like asset gatherer, I think is also really important. And if you are going from fund one to two or two to three and increasing your fund size, I think just having like a clean, crisp answer as to like why you're increasing is important. Whether it's that like, okay, we're so overburdened with opportunities, we just don't even have the capital now to deploy them all. Like we can very reasonably do 3 or 4 more deals or increase our check size while still offering co-investments, like whatever it is, I think is also important just to have kind of a clean answer as to like why you're increasing the fund size as well and not doing it, I think, too quickly.
We had a private equity fund and they just weren't calling capital. And it was driving us crazy because we do kind of track our liquidity and what our needs are. And we had a phone call with them and they showed us their pipeline and they showed us literally every deal that they had passed on or had not won. And it's simply because they weren't willing to pay ridiculous prices. They were being outbid left and right. And that made me feel I wasn't so great because we weren't getting called, our capital wasn't at work. But on the other hand, knowing that these guys don't overpay, knowing that they are disciplined, speaks volumes.
Yeah, and that we were a little bit in that boat. So our final close was back in 2022, and we were a little bit slower to deploy when we were first starting off because just valuations were through the roof, and we just didn't want to pay, and we just needed to wait it out a little bit. And so we called up, well, I wasn't here at the time, but my founders called up, especially our LPAC members, just to say, hey, are you like, just let you know, like we are going to be a little bit slower to deploy than we would have liked. Like, just want to run that by you. Like, are you okay with that? This is why we're doing it. And their response was, this is why we hired you. Like, you make those calls. And so there, again, we tried to get in front of it, and there was that understanding as to like, there's a very specific reason as to why we're being a little bit slower to deploy. And that's not necessarily always going to be the case. But we felt it was with good reason. So.
Yeah, we also have a couple of side letters that say if you don't use our capital by a certain date, there's a return. But that I'm not sure that's always the best thing because then again you feel, oh God, I'm going to lose this money if I don't spend it, I'm going to lose it. And so I think what Kerry says is we have to ultimately look to you. We give it to you. The reason that we give it to you is because we trust you. Right? That's the fun. Do we trust this person? And the more skin you have in the game, the better we feel about that.
So I want to dive a bit deeper on this, Ron. So because sometimes especially for emerging GPs, it's hard to break that glass ceiling of, okay, I got a meeting with a family office, and from that, okay, I got a meeting, they're excited or they seem excited to, okay, they're going to commit and we're going to be partners. Inside, like this is kind of a gray area for a lot of family offices. So for a lot of GPs. So if you're in, put yourself like in the shoes of a GP from your family office perspective, like what are the kind of the three key steps to raise from a family office without having to build a relationship for 3 or 5 years, for example? What would you do if you were in a GP's shoes?
I think Thomas, you said it earlier that the key piece is neither general nor limited. The key word is partner, right? Family offices can be your best friends, right? We can invest at the scale that you need. A lot of institutions, if they can't write a $50 million check, they don't care. Okay. We'll write a $2 million check if we like a strategy. We'll write a $5 million check if if we believe in you. It's not so much. We're not. Mentoring is the wrong word, but we are willing to grow with you because we think you have an exceptional skill or an exceptional strategy, or we like the way you look at the world, and we want to be part of that. So I keep going back to, transparency and truth, but but it really, really does come down to that. Much more so than say with when BlackRock comes or Blackstone or KKP, TPG come knocking on the door. I mean, then we know the horse. We don't know any of the jockeys. And so there we're kind of letting go, right? But there is this push pull that we've discussed. So.
And just one point on the, GP versus LP, it's about partnership. Like, I think it's also just important to remember that it is a two-way approach. And I think sometimes if you're starting out with a fund one and fund two, and like you're really, you need to raise money, like that's your business depends on it. There can be times where LPs come to you and they want really steep discounts or they have all of these asks and demands. And I feel like it's also important as a GP to also kind of know your own value and not acquiesce on like all the terms. I think it's important to be flexible. And especially if somebody's willing to back you early on, you want to create that good kind of cycle and partnership, but also just don't get into some type of arrangement that's going to really eat into your economics in a way that could be detrimental to how you're ultimately running the business as well. So I think that's something to consider because also, and if somebody's willing to back you in fund one and maybe you give them a steep discount, you also want to know that they're in it for the long haul and they're not just doing it to get something for cheap. And then when it's time to re-up for fund two, they end up not backing you. So I would think that I also just think remembering that it's a two-way approach is important too.
Real world example went down this week in our office. Okay, we are trying to figure out how we can benefit from AI, and we basically identified three things. One is start using it, right? Streamline, reduce costs, use it in the office. The most obvious way is then go buy a company, NVIDIA or whomever, or a key supplier in the public market and do that. But we chose to take a private market approach. And we had a parade of AI funds walk through the office over about a 5-day period. So Monday through Friday, we talked to at least one, and in some cases, two a day. AI is so new. Nobody really knows how to invest in AI, but everybody wants to invest in AI. So what happens? All the major fund companies, again, the Blackstones, whoever it is, they're all going to have an AI fund. The fund that we picked was small. The fund that we picked is run by another family office. Why? Because they've invested in AI verticals now for 3 years. They've made 6 investments. They've exited 3, and they've got a 4th that's ready for exit. So we are looking for people who've actually done this, right? Not looking for people who say, oh, there's a need in the market and we can fill it. Does that make sense?
Yes. We have a question also from Pamela in the chat. So She says we're on fund two with a variety of institutions, family offices, foundation, and individuals. We have an informal LPAC and reach out to stay ahead of things and provide regular communication to all investors. We're close to nearly all LPs and see them often. If slash when does it make sense to create a formal LPAC?
When does it make sense?
Sorry.
Pamela, go ahead.
I'm not sure
Go
if she
ahead,
wants to go
Carrie.
off mute or if I can just repeat it. She had just asked when does it make sense to create a formal LPAC? They're on fund two, they've got an informal one, and they're close with all their LPs. I mean, just speaking from experience here at Mavericks, again, we're investing out of fund one, about to raise fund two. We've had a formal LPAC from day one. For our fund one as well, we have it based on what we call anchor and strategic LPs. So our anchor LPs have a seat, and then our strategics have an observer seat. So we've just had that kind of as a stipulation from fund one. So it sounds like if you have an informal LPAC going on right now, and if that seems to work, then maybe keep it. But I would definitely consider probably when you're going to raise fund three to consider having something along those lines and just creating kind of guardrails as to like what defines being able to have a member observer seat.
Yeah, we're really not of a scale that we get invited to sit on a lot of advisory boards. At least, in some of the fund levels, and others, we've been invited, but we don't feel we can add any value. So the people you want on your advisory committee are people who kind of understand what you're doing, maybe also have a history of investing in the strategy or have a history with you. And then, maybe you want to make them available to other LPs, but that gets a little hairy. So,
Yeah.
Yeah, I would say just from my quick plug for fund of funds. If you do manage to get a fund of fund as an LP, I think that they're valuable members of LPACs. Personally, a lot of them sit on potentially 50 plus, 100 plus LPACs. And so I think that they can be good partners to advise on, kind of what's, kind of typical or standard on certain issues because they're kind of seeing it across the GP landscape. So.
Yeah, and to double down on that, I think, for me, the LPAC is really a fundraising channel. So you have to be close, not too close, so you stay in control of the narrative. But the best practice, in my view, is like you have three LPACs plus an AGM. They don't have to be formal. So some GPs resist having that in the LPA, and so that's totally fine. But the more LPs are up to speed on your story, the faster your next fundraising, assuming everything is going according to plan, and taking it that into consideration, because I see a lot of GPs shooting themselves in the foot, not having these LPACs. And so fund two, which is supposed to be an easier fund to raise, becomes very hard. And if they don't have metrics for fund three, it becomes like so hard. And we work actually with a US firm. They raise fund one, and they have an investor call every quarter with all investors. So they're free to join the share deck. It's very the way I love the way to do it. It creates a bit more work. But then their fund two now being raised is just so much faster. They just have to focus on new relationships. The fundraising is done for the existing relationships. So they have a good perspective on who's coming back, which also brings more confidence, more trust when they go to talk to new relationships because they have the real kind of perspective. Highly recommended. I think as you start with fund one, making sure that you stay in control of the narrative. Some LPs tend to want too much information, you lose control. So as long as you stay in control, there's nothing wrong with Corley.
Yeah, and it's come in handy for us recently. There was a slight amendment that we needed to make to our LPA. It was minor, but it was something that we had to notify all of our LPs about. And we do have a very diversified LP base across large financial institutions, Crown Corps in Canada, high net worths, family offices. So everyone was notified, but it also was just something that it was a voting matter and we needed at least 50% of LPs to approve. And so it was also helpful to just kind of have our go-to kind of formal LPAC to send them an email with detail, offer up like a group call or individual meetings just to get them aligned because them alone would have just easily gotten us to over 50%. And so while we did get some participation from the high net worth individuals, and again, it was a very minor point, I think it was just really helpful to kind of have kind of a formal uh, committee that we could kind of go to first, that we knew that we could kind of get it approved without issue.
And so we're in the last part of the webinar, like we have 20 minutes left. We wanted to do this really to make this useful. So I see another question. Maybe I'll just take it from Omar. You run a boutique public debt strategy that offers private credit-like returns with great liquidity and lower volatility. How do you recommend we convey that nuanced value to gatekeepers who often have narrow marching orders that may not align with what the families themselves prioritize?
What a great question, Omar. The answer is that I mean, my experience with other family offices, and we share a lot of what we do, is they're willing to sit down and listen to that. As I stressed at the beginning, that we are very eclectic in the way that we allocate, and I don't think that makes us unique in the family office universe. I've been shown some really different approaches to different things, and frankly, right now, one of the things that drives me crazy in investing, and family office fall victim to this too, is that everybody moves from one thing to other. Everybody's in private equity, everybody's in private credit, and everybody's trying to chase returns when the returns have already been made. Okay, this isn't your weakness. This is your strength. Okay, this is your differentiator. This is how you're not going to get caught up in the crowd, because you're looking in a different place. Okay, we decided we wanted to allocate to synthetic risk transfer. Okay, it was exploding in the US last year after the Fed finally released their guidelines. They were in line with Basel III, and we were getting calls from funds in Denver and all over the place. We ultimately went with a London-based house that does synthetic risk transfer, but they are laser focused on Southern Europe. All the countries that defaulted, Greece and Italy and Portugal, and they're knocking the hide off the ball because they're not chasing the same thing. This is your strength. You've got to communicate. How do you convey it? That's harder to do, but that should be in your opening pitch.
Perfect. Thank you.
Yeah, and it's also interesting just to think about with family offices. Like, I don't know if you've been speaking more with like smaller family offices where like the family themselves are playing more of a day-to-day role in investment decisions versus like it's, a larger family office that's been around for longer. That's truly kind of the family has like outsourced it to the investment staff where basically they have discretion just to kind of operate on that mandate. So I guess also it maybe depends a little bit too on who you're speaking with.
I have a question for you, Carrie, on this. Like, when you build relationships with family offices, do you optimize for volume, like a sales-based approach, or do you optimize for relationship building with more curated, warm intros? And which one works best in your view?
Definitely the latter. It might be slightly less efficient. I'm very anti sending out just like blanket outreach, and have it like I tailor, again, this is probably not the most efficient, but I tailor like every single email that I'm sending out to try to also optimize for a response, and make it very clear that I've adjusted it to speak to specific family offices, whether it's that I can play on some connection that through Mavericks that's established, a referral, something relating to John or Mark, like our founders. I definitely try to optimize for customization and having a more bespoke approach to just kind of blanket outreach personally. And it's tough because it's a fragmented market, and so there's so many family offices out there. So I definitely leave some stones, you know, I definitely don't, I'm not able to address every family office in that regard, but I feel like we have a generally kind of higher response rate and success rate with the ones that we are kind of going after. So, and we typically are right now, at least we've focused, like we have about 20% of our client base for Fund One is family offices. We're having a lot more conversations for Fund Two as well. And then also we are working with a placement agent to raise some capital in the US. And it's early days in terms of us focusing on our US outreach. But we actually are getting, I would say, a good amount of interest and momentum just getting initial calls set up with folks there.
So I just want to go back to Omar's question because I didn't answer it because he wants to know how we can how we can get past the gatekeeper. Gatekeepers can be just a huge impediment. You could have a great idea, you know it's a great idea, and if you know you could just get to the guy behind him, he would listen to you. But the gatekeeper says, "This is my task, this is my function. I have to keep that guy happy, or that or that family happy. So how do I do it?" If you're having success with one family or two families, ask them who they know. We have a call every single month where we sit around the table with anywhere from 8 to 14 family offices, and we call it the Mini Sone Conference. We talk about our best ideas. We talk about what's working for us. We're talking about who we like. We talk about what we've seen, right? Because the family office universe, we don't have huge staffs. Some of us are 3 or 4 people. It's rare to have more than 10, right? So we collaborate. We're natural born collaborators. We thrive on community. So if you can get to one and they're having a good, and you feel that it's okay, listen, I know it's early days, but I think, you've seen it, that we've proven our strategy to you. We said we were going to do this. We've done this. Are you happy? First, find out if they're happy with you.
Absolutely.
And if
Okay.
they're happy with you, say, do you have friends?
Okay. Well, Ron, I'm going to put you on the spot. I'm going to ask at some point through Amin for your email. This way, our family
Sure,
office.
I'm going to give everybody an email. They
Okay.
can dump all their
Because we have
stuff
a
on.
family office that is backing us. They're a single family office, and I'm actually going to have the person who runs that family office reach out to you and potentially join that call and let
Okay,
him
so
talk.
here's the email that everybody can use because I have to filter. There. I can't guarantee a response, okay, but I will tell you that we look at everything that's sent to that box in good time. A lot of it is triage.
Thank you.
Curious if there are, what are your main pain points talking to the GPs on the call and we're in Q&A mode. So what are your main pain points? What's your biggest problem today in your fundraising process or in your outreach process to get new LPs?
Is that a question for me, Thomas?
Yeah, let's start with you, Omar, maybe.
Yeah, I think that the biggest thing is just what I said. Everyone is talking about, private credit, like it's, the hottest thing. And I don't want to be overly cynical, but, my background is
Oh,
similar to Ron's.
please be cynical.
At the point in which it's making its way, and I mean no disrespect to this, but at the point in which it's making its way to family offices and they're finding ways to get it into retail, the trade is already done. So you are literally picking up pennies in front of a steamroller. And I think that the best trades come when you're running into a burning building. And it's not to say that you are to have an outsized position, but you need to at least be considering, why is everyone doing this? And why are there so few people who are extremely successful in investing? And those people usually, family offices and retail is typically providing liquidity to the folks that have already put the trade on. And so I think that public credit, I'm gonna talk my own book, so I apologize to everyone in advance. I think that public debt is a very interesting space because it's been largely commoditized. And so the pennies in front of the steamroller are actually a lot larger than pennies at this point. But when you look at the top 20 asset managers globally controlling more than 40% of the globe's assets, you realize that there's an opportunity for a proven team that has a track record working at these firms and understanding exactly how to access the liquidity in times of stress. So a lot of I would say that the juice is not worth the squeeze in general private credit, but there are opportunities for there to be, there's opportunities in probably every asset class for smart people who are not the standard fare.
Yeah, no, I mean, listen, the big fund complexes are counting on us to be the greater fools. And that's the last thing we want to be.
Understood. So thank you for your time. And again, thank you for putting this all together. I think that like for all of us, the gatekeepers, everybody feels like they're different and they feel like they have a good idea. And I appreciate it. And I didn't appreciate it fully when I was working at a bulge bracket investment bank managing a team, but I do understand it now. And singing for your supper takes a different type of resolve that everybody on this call has, because we all know what it's like to be told no, be hung up on, feel like we had a great call, never to be called back or answered again. And I think that, what my advice would be
But
to everyone.
everybody wants to be a nice guy. Nobody wants to be, an asshole. And so everybody is going to seem more interested than they may really be. And I'm
Right.
sorry, Omar, but those are the vagaries of business development. That's what, in my opinion, makes it the hardest non-physical labor in the entire world. I don't know you. I don't know your fund. You seem like a nice guy, and you want what?
That's
So
exactly
it
that's
is
exactly right.
hard. And if you can't get your head around that,
You're
go back to
absolutely
the
right.
investment bank,
Fortunately,
and they'll give you a script and a product, and it's what everybody's chasing.
absolutely. Fortunately, I learned my lesson and paid my dues as an analyst trying to cold call big asset managers to allow them to have me call them. And I got hung up more times than not, and they didn't have to be nice to me. But I think that we all have thicker skin than when we started. And I appreciate your time on this call, and I'll
I
be
mean,
in touch.
I actually try to be realistic. Like if a guy's 5 minutes in, I'll ring the gong.
Good.
Okay. Yeah, he will then say, yeah, but just let me tell you more, because in
No,
his mind, he knows he can persuade me. And
right,
in my mind, I know I'm now making grocery lists.
right.
Okay. Because I've
Yeah,
gonged out. And that's also, it's interesting. I seldom really have to pitch something.
right.
But when I do, so when we're reaching out to another family office with an idea that we think is spectacular, I say, gong me. I said, you're busy, I'm busy. If this does not resonate with you, let's move on. But that means your first 5 minutes have to be really effective.
Right.
Okay.
Understood.
So whatever your secret sauce is, whatever your differentiator is, okay, whatever your proof case is, we love proof cases. First thing we always ask, what was the best thing you ever did and the worst thing you ever did? Explain this drawdown to me. Okay. And what did you learn from that?
Right.
Okay. That, are you smarter? We all make mistakes. Are you smarter because you made it, or are you just gonna make the same damn mistake again?
That's right. Thank you again, Ron.
And run on that. How important is it to have information about the family office you're about to meet? Like, is that important at all in your view, or like you just like how a GP should prepare to meet with you? How do they know that maybe you have more interest in buyout versus private credit or any other asset class?
Well, that's hard to do. You can always ask, but you don't necessarily want to. Because I mean, from time to time, not often, but from time to time, someone will call me up and show me a strategy and it's just not resonating, or I'm fully allocated, or, whatever. But maybe, just maybe, I know somebody who would, in which case I'll say, you know what? I'm going to ask my friend so and so if they'll take a call from you, and try to pass it on. But it's hard. That's hard to do. Yeah, I mean, so we actually the five guys in our family actually identified a guy that we thought would make a great partner for our family offices. This carry over to what you're doing. And so, and we were actually going to open up the family office because just to have this guy's brain power, to have this guy sitting at the table, would be a huge win for us. And so I reached out to him and I said, this is what we do. What do you do? And he sent me back a fulsome email, 4 parts of what he does. There was zero alignment. Okay, he wasn't interested. He was all venture. We're no venture, or we're limited. Thomas, as you know, we're limited venture, but and venture is one of the things where we get involved. Where when we do get involved, it's never direct because it's much more art than science. Right, and it would be, if we started to do that, it would be amateur night at the circus, because every venture idea looks great when you first hear about it. Well, that's brilliant, but whether it has legs or not is a totally different thing. But so I don't want to overemphasize it, but if you can get some kind of insight into what they do. Find out. Just call them. Do you do private equity? How do you do private equity? Is a good way to lead. How do you invest in venture? Tell me about your. So we had a private equity deal, and I called a family office. Didn't know him from Adam. Somebody said, "Give these guys a call." Here's the introduction. I called him, and I didn't know whether this idea was going to fly or not. So the first question I said was, how do you deal with private equity? How are you invested? What are you looking at? That way I could find out. He didn't like it. Funds only, direct only, some combination, wanted to have some expertise. It's like that famous reel from The Wolf of Wall Street that says, "Sell me this pen," right? And the guy sits there and he tells, "Oh, you want this pen because it's blue and it clicks and all this." And first question is, what are you looking for in a pen? That'll save them time. It'll save you time.
Perfect. So I think we're reaching the end of the session here, and I see a question from Bachimek. Please, we're all ears.
I was curious about how family offices manage risk, particularly when it comes to families that are focused on impact investing, but there's certainly risk to impact as well. So if you have any experience in that, I'd love to hear it.
So we do a lot of correlate. First of all, impact is a totally different asset class. Okay, and there are criteria that don't apply. Like, this is our gut. This is something that we want to do. This is helpful. And if we don't make a ton of money here, that's okay because we think this is good. But in other words, you're much more inclined to take. You're never going to take a flyer, but you're much more inclined to kind of drop some of your other return criteria if you feel that the objective is a strong one and it's something you want to be aligned with, or these are people that you want to know, right? One of the things we find when we do impact is there's a lot more cross-pollination between the LPs and right. We go to meetings together and we talk about impact, and so there's a human capital benefit to that. There's a social capital benefit to that. So it really is unto itself. But in terms of determining how we allocate, we just run regressions and correlations, and we're just trying to. But that, and again, in our family office is very different because we actually thrive on volatility. Not we will. That's a lie. we don't thrive. We can suffer volatility better than most because our theory is, right, that if you have a well-diversified portfolio that returns 7%, and you're happy with that because it's a nice smooth 7%, or you have a diversified portfolio that returns 15%, but you can suffer the volatility, we'll take the 15% any day. But then you've got to, and that's where the correlation comes in, right? Is a 2% increase in interest rates going to knock me totally off the horse? Right? So that's kind of where that's what we do. And a lot of it, for what it's worth, is now AI generated. Hugely helpful in risk analysis, huge time save.
Are you guys building your own, or are you outsourcing the AI tools?
Right now, we're doing it internally.
Very good. Thank you.
We have potentially time for one more question. GPs, if you have one last question, this is going to be the time for it. All right, I guess there's no more questions. All right, well, thank you so much, Ron, Carrie, and Thomas, for this incredible session. And thank you all GPs also for coming in today. Honestly, Ron, Carrie, Thomas, this is one of the to message. Oops, my Siri talked. This has been like one of the best sessions that we have, best workshops, and every content that you shared was honestly incredible. So thank you so much. For GPs, this was our last event of the year. We're now going to take a break, and we will see you all in January and actually in February for the first in-person event that we're going to do in Miami, which is going to be a cocktail bridge matching with 10 LPs, 10 GPs. So if you are interested in Miami, I would say go book your slot as soon as possible. And we look forward to seeing you all very, very soon.
Thank you, Amin, and thank you, everyone. And I want to say, if you want the deck, feel free to email me at thomas@vessel.co. I'm happy to set the deck, or I'll send it to you. I mean, whatever works best.
Yeah.
Thank you.
Thanks, everyone.
All right.
Thank you, Carrie.
Happy holidays.
Happy holidays.